Hello, everyone. It's Taylor Max here. I'm coming from snowy Bingham Farms, Michigan, and awfully cold too. Hope everyone had a great start to 2024. Had a great holiday season. Hopefully, able to spend time with family and friends. It was certainly nice being able to see everyone at our holiday gatherings, both here and in Grand Rapids. Over the last month or so. So, hope everyone's had a great start. For those of us who grew up here, were raised here, or even lived here and moved away, if you're a Lions fan, it's certainly been an awesome start to 2024, getting our first playoff win in 32 years. So the city's buzzing, it's alive. It's been a really fun way to start the new year. Full disclosure, this is after the Rams victory. We haven't seen the outcome of what happens against the Buccaneers. So just wanted to point that out there. Want to put a ribbon on 2023, but the stock market and frankly for investors as a whole. The fourth quarter was strong. We talked about the fact in the last video we did that the fourth quarter tends to be a strong quarter for the markets for a variety of reasons. Retail sales around the holidays, seasonality pushing through of the September, October months that generally tend to be, more challenging for investors in the market as a whole. And that's shown through in November and December in particular. So, it was a great finish to 2023. The primary reason that we were optimistic as a result, not just because of the higher values, was we saw a broadening of market performance. It wasn't just the Magnificent Seven driving that performance in the market. We saw small and mid-cap stocks outperform their large cap counterparts, right? So the small and mid-cap indices actually outperformed, the S&P 500, the NASDAQ 100 composite indexes, which was nice to see. Bonds turned into positive territory. Bonds had a great fourth quarter, something we've been waiting for, frankly, for quite some time over the last couple of years. And the broadening is important because, there's no guarantee of what's going to happen in the future. But it tends to be more of a bullish signal. When other companies, sectors, industries outside of just the largest seven in the world, start to, or at least in the U.S., start to perform and to participate in the upswing of the market, it tends to be more of a bullish signal, historically speaking. So that's certainly something we were pleased to see, and frankly, we were waiting for. 2023 ended up on a good note. Turning the page to 2024. Which we'd like to talk about a little bit here, is there's an elephant in the room. The election that's occurring in November. The election is going to create negative news cycles. We've experienced that the last couple of them. It's going to supercharge emotions, but it doesn't necessarily have to mean, a bad market year. In fact, 10 of the last 12 election years have actually seen calendar year positive performance for the S&P 500. So while we're going to hear, supercharged rhetoric, there's probably going to be a lot more negativity in the news. We got to tune that out and focus on the fundamentals and the fact that the economy is strong. So speaking of those fundamentals, the economy remains strong. Unemployment remains low. The consumer remains strong. And most importantly, the Federal Reserve has indicated and communicated that the rate hiking cycle is likely stopped. They actually, communicated that we might even see some rate cuts next year, which the market started to price in, which could be super positive. 12 months out from a rate hiking or a post-rate hiking cycle, historically speaking, the S&P has been up about 16%. Again, no guarantee of the future, but if history, if history rhymes at all, we could see, potentially another positive year in the S&P 500. One of the other benefits of the Fed, cutting rates is the fact that for a while now, risk-free assets have been paying 4 to 5%. Think short-term bonds, treasuries, high-yield savings accounts, and over $1 trillion was plowed into money market funds as a result. So out of the market, out of bonds, out of stocks, which put investors, cash holdings or cash equivalent holdings at $1.2 trillion. $1.7 trillion, I believe. That's a lot of money that's sitting on the sidelines. If we start to see those rates come down, we believe investors will start redeploying that cash, back into potentially higher yielding investments, such as stocks, bonds, etc., which could be more of a positive swing for the market. Now, it's not without risks. Even though the economy is strong, the fundamentals look good. 2024 is not without risks. The Fed could always reverse and become more hawkish again. That's what they've done for the last 2 years. If we don't see inflation moving towards their 2% long-term target continuously, they could turn more hawkish, and that would probably lead to a sell-off in both the equity and fixed income markets, because it would go against the narrative of the fact that we're going to see rate cuts. And I think it's important to note too that even though the market bounced back in 2023, a lot of the rate hiking cycle hasn't really hit corporate balance sheets yet. Now, it's not going to affect every industry equally. There will be certain industries who benefit from it. Think banks. There's other industries who are going to be rather agnostic, consumer staples because they can pass on those costs to the consumer. But something like a commercial real estate, right? There's $2.8 billion or trillion dollars in loans that U.S. banks hold for commercial real estate. 500 billion of that is coming due in 2024. So that industry is already in more of a challenging environment due to the post-COVID world, work from home movement, et cetera. And now $500 billion of low interest rate debt is going to have to be refinanced. That could potentially put some struggle and some certainly some stress on cash flow for those companies. We're hoping that we don't see defaults, but if that occurs, that could certainly provide some turmoil to the market. And corporations aren't the only ones who are going to be refinancing debt. The federal government has to. For a long time, even though this 30-some trillion dollar debt number that we've been hearing about, continuing to grow, has not really been impactful because rates were so low. Well, we have to refinance that. In just 2 years, our annual debt service has gone from, I got to look at it because the numbers are so big, $352 billion a year, all the way up to almost $700 billion, just as a result of the recent rate hikes. At some point, this is going to have to be addressed. We don't think it's anywhere in the near future, but it's certainly going to have an impact on the election. It could potentially have an impact on the economy at some point as well. So those are kind of a few of the risks we're looking at, aside from some of the the geopolitical ones we've discussed before, Ukraine, what's going on in the Middle East right now. We're trying to manage risk the best we can in that regard. So, 2023 was great. 2024, there's reasons to be optimistic, but there's always the potential for, challenges on the horizon. So we'll continue to manage risk appropriately. Our ask is that we just maintain, the long-term focus. The election, again, is going to be everyone's biggest concern this year, and understandably so. But let's focus on the fundamentals. Let's not let politics drive our portfolios. And let's stick to our financial plans. So looking forward to a great year. I hope to see and talk to every one of you rather soon. And again, hope everyone has a great 2024, and thanks for your continued trust. See ya.